max fund an IUL, and become self-insured tax-free. In this episode, I'm going to address the question, how to reduce the cost of life insurance. You're going to be blown away. Get ready. So I'm Doug Andrew, and what do I know? Well, I've been around the block for a long time. I'm an old geezer. I started in 1974. Back then, I got my insurance license and my Series 1 securities license, and I proceeded in the financial services industry to license and train thousands of insurance agents, but also tens of thousands of clients, and also now millions of Americans who have learned about the merits of max-funded insurance contracts to be used for living benefits instead of just for death benefits. It's one of my favorite vehicles that, if it is structured correctly and funded properly, will knock the socks off of most places where people accumulate money, such as IRAs and 401ks in the market. I know, because I used to tell my clients to buy term and invest the difference. Well, no longer. Buy term, invest the difference under a tax-free umbrella, and you'll knock the socks off of that old theory. So this is what I've learned through the years, and when Universal Life was introduced back in 1980 by E.F. Hutton, that's when my clients were never happier than when I got them out of the market. Now, there's a lot of naysayers, even insurance agents that sell whole life, that say, oh, Universal Life is going to crash and burn down the road. The cost of that is going to go through the roof. And I go, they don't know what they don't know. The actual cost of insurance goes down as you get older. It becomes cheaper. It will blow out of the water max-funded whole life insurance, and they don't understand it. So get ready. I'm going to teach you how you can make your Universal Life policy get cheaper as you get older. So the objective of a max-funded insurance contract is primarily for living benefits, hence life insurance. Most agents sell life insurance for death, and frankly, whole life is built on a chassis that's primarily for death benefit. Even though you can use it for life, you can access money. But if you are accumulating money tax-free in an insurance policy, which you can do under Section 72E of the Internal Revenue Code, which has been around in one form or another for over 108 years, it's like a sacred tax-free cash cow. But if you want to access money out of your insurance policy for retirement income, working capital for business, real estate management, you can do that under Section 7702 of the Internal Revenue Code. And then when you ultimately die, anything left behind in cash value then helps the policy blossom in value and transfer income tax-free to your heirs, your beneficiaries. Now, if we talk about reducing the cost of insurance, let me show you how to make your Universal Life policy, and I'm actually partial to Indexed Universal Life, which came out in 1997, which allows you to participate when the market goes up and not lose when the market goes down, because your money is not invested in the market. You're linking your returns to what the market does, but your money is safe in the insurance company. So using Indexed Universal Life, most of the students that I have, clients who use Indexed Universal Life and structure it properly and fund it correctly, they end up averaging 7 to 10% rates of return, but some years they earn as much as 16%, 25%, 61%. Other years, they don't earn anything when the market crashes, but they don't lose. So how do we keep the cost as low as possible? I'm going to simplify this. Get ready so that you can envision how this works. Now, before I explain how this can become cheaper as you get older, if this is intriguing you and you can think of somebody who ought to watch this episode, be sure and share it, post a comment, click like. But most importantly, subscribe. It's free, and when you subscribe to this channel, Three Dimensional Wealth, click the little bell there, so you'll be notified every time I post a new episode, which I do almost on a daily basis. But stay with me to the end. I want to gift you a copy of my most recent best-selling book, The Laser Fund. 300 pages. Do not pay retail of $20. I'm going to gift you a copy. Okay, so how does this work? I'm going to simplify this. Let's say that you're a 60-year-old male in good health when you open an IUL policy. Now, if you wanted to reposition, let's say $500,000, and there's nothing magic about this number, it could be 100,000, a million, but usually people would come and say, Doug, I have $500,000 that I need to get out of, maybe 200,000 out of IRAs or 401ks, get the taxes over and done with sooner than later at today's lower tax rates. Yeah, that's smart. Maybe they have another 200,000 in the market and they're sick and tired of market volatility, whatever. Maybe they're selling a rental property and they don't know what to do with the equity that they got from selling the property because they don't want to be a landlord anymore, fixing toilets and evicting tenants. Whatever it is, they reposition money. Maybe it's even 100,000 sitting in some bank or credit union earning a measly 1% and they want a higher rate of return and increase the safety. That's why people reposition money into a max-funded indexed universal life to increase the liquidity, the safety, and the rate of return. So let's say at 500,000 and you're a 60-year-old. Now you have to comply with TAMRA, the Technical and Miscellaneous Revenue Act of 1988, so that when you go to access money, it's tax-free. So you may only be able to put in 100 to 125,000 a year. So it may take you 3 years and 1 day or 4 years and 1 day to get all of your 500,000 into the policy and comply with TAMRA to avoid a MEC. That's a modified endowment, where if you violate TAMRA and it becomes a MEC, your money still grows tax deferred. But if you take money out, it's now taxable LIFO, last in, first out. You don't want to do that unless you don't care. So most people comply with TAMRA. So let's think through the math. The minimum death benefit under TEFRA and DEFRA tax citations for a 60-year-old might be $1,250,000 of insurance. So I'm going to put in 500,000, and I do in 3 years or 4 years. I put in 500,000 of cash, the premium, and the death benefit that was originally required was $1,250,000. Now I have two choices. I can either have my cash added on top of the death benefit, which means the cost of insurance is going to keep going up as I get older. That's not the objective. I want the highest payout or rate of return. So I can actually have the cash that I pay into there and the interest that is earned on that money qualify as part of the death benefit, which means if I die, it's part of the death benefit. But why is that such a good idea? Well, when I put in 500,000, how much is the insurance company really at risk for when I die if the death benefit is $1,250,000? It's only the remaining $750,000. So let me make sure you get it. If I put in 500,000 and the original death benefit was $1,250,000, the insurance company is really only at risk for the remaining $750,000. So when I get the money in over 5 years, the actual amount of risk is going down. So even though, life insurance, the cost per thousand goes up each year as I get older, because all insurance basically has a term insurance cost component in it. Whole life does, okay? But your cash values sort of help cover that. With universal life, the actual amount at risk is less. Now, most of the universal life policies that I've designed and so forth, they usually have averaged between 7 to 10%. If it's earning 7.2%, that means that $500,000 will double to $1 million in 10 years. Many people are earning 11 and netting 10 after the cost of the insurance, which means 500,000 will double to $1 million in 7.5 years. In actuality, the average has been 9.6%, which means it will double every 7.5 years. So in 7.5 years after you've got that money in there, the $500,000 doubles to $1 million. How much was the original death benefit? $1,250,000. Now the insurance company's only on the hook or at risk for $250,000. not $1,250,000, because $1 million of that money is your own money. You have become self-insured. And so the cost of insurance they're charging you has gone down, down, down. Now, let's go another 7.5 years and the million doubles to $2 million. Well, $2 million of cash is way more than the original death benefit of $1,250,000. So what happens? Under TEFRA and DEFRA tax citations, the insurance company then has to have your death benefit grow with your cash, and there's usually about a 5% cushion there. So if you have $2 million of cash value, the death benefit's usually $2.1 million, $100,000 more, 5% more. But the insurance company's only on the hook now for $100,000. Well, you're earning interest on $2 million. If you're earning, let's say 10% to keep it simple, that's $200,000, and the cost of insurance might only be, $10,000 or so. The cost of insurance is getting cheaper as you get older. Pretty soon the interest on your cash value is way up here, and the actual cost of insurance on the remaining amount at risk is clear down here. This is why as you get older, the cost of insurance gets cheaper. Sometimes I ask audiences, so have you ever seen an insurance policy that gets cheaper as you get older? No? Well, then you haven't seen a universal life policy structured correctly. It gets cheaper as you get older. 30 years down the road, my universal life policies are costing the least amount. If I earned in that year, let's say 11, I would net 10.9 because I'm earning so much interest over and above the actual cost they're charging me, because the amount at risk is 1/20th what it used to be when I first started the policy. I have become self-insured. So when you self-insure your universal life, it will get cheaper as you get older. So if this is blowing you away, it's intriguing you, I want to gift you a copy of this book called The Laser Fund. The Laser Fund is what I call a max-funded IUL. There's a lot of universal life policies that are created that are not structured correctly or funded properly. They would not be qualified, in my mind, to be deemed a laser fund. Laser means liquid assets safely earning returns, where the cost of the insurance gets cheaper as you get older. To learn how, I want to gift you a copy of this 300-page book. So click on laserfund.com or go to laserfund, laserfund.com, and you contribute just a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you. It's 300 pages, charts, graphs, explanations, and this side has 62 actual client stories, so you can use your right brain or your left brain or your whole brain to learn. But here's the deal. When you go in there, there's options to listen and learn, watch and learn. Check out some of our educational events, like a 6-hour event called Retire by Design. We do these about once a month, and they're done virtually or live. And if you are intrigued, you can do a deep dive into how to accumulate, access, and transfer your money totally tax-free and make sure your life insurance gets cheaper as you get older.